70% of trader losses on gold don't come from bad analysis. They come from literally one stop-loss mistake. Welcome to the Gold Execution Bible. Today, we're not doing generic technical analysis. I'm going to show you exactly how professionals execute gold trades using institutional smart money concepts. Because let's face it, trading gold isn't a guessing game. It is precision surgery.
Look, gold is an entirely different beast. We're talking about an asset that can violently move $50 in just 3 minutes. And why does it do that? To take liquidity from impatient, reactive traders. That establishes the intense battlefield we're operating in right now. One wrong entry rule, one little moment of hesitation or FOMO, and your account is absolutely destroyed.
Okay, let's dive into this and expose the amateur trap, because this is your first step to actual survival. 90% of traders out there think they're trading smart money concept, but they're really just feeding liquidity straight to the market makers. The painful truth is that entering a trade just because you spotted a random engulfing candle, a pin bar, or some blind touch of a supply and demand zone is a massive trap. Without higher-level context, those isolated candlestick patterns are literally engineered to induce retail buying and selling right before the real institutional move drops.
So here is our ultimate no-nonsense Gold Execution Bible briefing designed to transform your reactive retail habits into disciplined institutional execution. We are going to cover the painful trading truth, the 3 entry confirmations, institutional stop-loss rules, liquidity-based take profits, professional execution management, and finally, time, control, and mindset.
Section 1. The painful trading truth.
The reason the vast majority of retail traders blow their accounts isn't because the market is some unbeatable monster. It's because their entire model is built on pure reaction. Jumping in on an engulfing candle in isolation, leaning on a random doji, or buying off a blind supply zone touch is a guaranteed trap. Why? Because without context, these patterns are specifically engineered to induce retail buying. You literally become the liquidity the market maker needs to trigger their own massive orders at a way better price. If you are trading on FOMO or a gut feeling, you aren't the hunter, you are the prey.
Section 2. The 3 entry confirmations. Let's move to and see how this builds. To stop being the liquidity, you need the proprietary ICT execution framework. Professionals do not guess. We use a strict combat checklist. Step 1 is context. You have to know the trend structure and exactly where the resting liquidity sits. Step 2 is the key zone. We're talking untested order blocks or mitigation zones, which are specific price levels where institutions previously injected massive volume. And step 3 is the trigger. You wait for a strong price rejection or a 50% fill of a fair value gap. Missing even one single layer of this checklist means there is no trade, period.
Now, inside that first step of context, you absolutely have to understand premium versus discount pricing. Premium is an expensive price zone, usually sitting above 50% of the current range. Institutions sell in a premium. Discount is a cheap price zone, down below 50% of the range. Institutions buy in a discount. So think about it. If you're buying in a premium zone, you are chasing terrible pricing. You are buying exactly where smart money is actively looking to offload their positions.
Section 3. Institutional stop-loss rules.
Now, what's really interesting about this slide is we're shifting to defense, and you are going to learn exactly why your stop losses keep getting ruthlessly hunted. There is a massive contrast here. Retail amateurs slap their stop losses tightly near zones, maybe just a few pips below a wick, based on some arbitrary risk-reward ratio, or honestly, just driven by emotion and fear. Professionals, we place our stop losses strictly outside major liquidity pools. If you're buying, your stop goes below the liquidity. If you're selling, it goes above. You place your stop where the market makers have absolutely no reason to return.
There's a rule that perfectly captures institutional risk management. A beautiful stop loss that is dead is meaningless. Look, it is vastly better to have a slightly wider stop loss actually survive the market maker's initial liquidity sweep and catch the massive expansion than to have a picture-perfect risk-reward ratio on paper but get stopped out prematurely. The market does not care about your risk-reward ratio, it only cares about liquidity.
Section 4. Liquidity-based take profits.
Now we switch to offensive execution. We have to learn how to extract capital from the market without letting fear dictate our exits. Amateurs take profit at round numbers, or because the price spiked and they panicked, or simply because it feels like enough. Professionals target liquidity, period. Exiting early on emotion completely destroys your long-term profitability. Your targets must be based entirely on where the next pool of resting orders sits. That means aiming for equal highs, equal lows, untested order blocks, or unfilled fair value gaps. You take profit exactly where the market is magnetically drawn.
Section 5. Professional Execution Management.
Listen, getting into a trade is only 10% of the battle. A wealthy trader manages that trade based on a strict preset plan, not the emotion of a crazy one-minute candle. Professional rules dictate you never risk more than 1 to 2% of your account on a single trade. Once the price moves 1R in your favor, you move your stop to break even immediately to protect your mental capital. You trail your stops behind structural highs and lows, not behind individual scary candles. And when that main liquidity pool is finally swept, you close the major volume. No gambling, absolutely no revenge trading.
Section 6. Time, Control, and Mindset. You can have the absolute perfect setup, but if you execute at the wrong time of day, your analysis is completely useless. This daily battlefield operates on a very strict schedule. The London breakout creates the initial liquidity and breaks ranges. After London, we enter the dead zone. Avoid trading here at all costs. This is where the fake outs and inducements are printed. Then comes the New York Open. That's where the true trend and real institutional volume finally emerge. And late in the day, the New York PM session usually gives us an end-of-day reversal to sweep whatever liquidity is left. You only trade when the real volume is flowing.
And this brilliantly illustrates an absolute rule you must burn into your brain. Speed is not direction. A sudden, violent price spike of 50 or 70 bucks is meant to induce panic and FOMO, but a fast candle is not a trend. Without structural confirmation, without a retest and proper context, it is literally just a liquidity grab. If you don't have confirmation, you do not trade. I don't care how fast that price is moving.
So what does this all mean? The ultimate institutional truth is this: the market does not reward prediction. It doesn't care how smart your analysis is. It rewards disciplined execution. Gold doesn't move to make you rich. It moves to take liquidity from impatient traders. So trade the plan, not the emotion. If you want more ICT execution breakdowns, liquidity mapping, and institutional gold trading logic, make sure to follow ICT Market Theory. And if you want to practice this execution model live, the trading account link is pinned right down in the comments. The market is opening right now. Are you going to trade your plan today, or are you going to be someone else's liquidity?